Good evening from myself, Willie Olofse. Yes, it's my first time in 2018 as a webinar host. Unfortunately, I think Michiel Lucas was also as one of the panelists shown on the initial board. He's unfortunately not going to join us tonight, as myself and him and the leadership team and the board of directors was on an offsite for the past week. So we arrived this morning back from Neisner. It was an awesome time, and I'll get more into some of those details. Yeah, so for that reason, I said to him, I don't mind going solo tonight. So yeah, so welcome, and I hope tonight's webinar is going to be informative. Um, as always, we are not giving any advice, and tonight is just to showcase what we are planning, what's been placed on the platform since December, and a lot of us have been on holiday. Myself was on holiday for about a month. And I hope you guys and listeners have also been resting well. But during the off time, we still had some people on the ground supporting us and made a couple of deals available. And that's the purpose of tonight's webinar, is to just run through those details. We want to really encourage you to please contact your advisor if there's anything that looks attractive to you, and then at the same time, if you want more details, to contact the investment consultants, register on our platform, and we will get in contact with you. So yeah, so just to kick off, as you can see from the slide, it's we're going to talk about the live and coming soon deals. That will include RH Medical 10, Osprop Logistics 1, the Lyle Group Living Works 1, ASC Medical 11, and then the RH Atlanta portfolio. Now, before I kick off into these different deals, I'm going to try and keep it short and sweet. And yeah, please feel free to drop us a question. Well, when talk us myself, and if I cannot answer it, if we run out of time, I will make sure that the investment consultants do get in touch with you to really communicate properly and make sure that you got a better understanding. So the idea of tonight is also just to give you a quick glimpse as to what is going to happen. As I said, we're on an offsite, and I'm quite excited about the plans and actions that we've are setting in place for 2018. I think the most exciting thing for me is the fact that we have employed global CEOs. They are based in the UK, United States, then obviously South Africa, the region called MENA, and Dubai, and then Australia and China. So we have really, Scott has been, if you follow us on the Global Wealth Group, you're a wealth partner, and you are looking through our blogs, you would have noticed that Scott has been busy end of last year to open up these branches. And the main reason behind it is to really drive what we call our demand side, meaning you as investors, and at the same time get a better feeling of our own men on the ground, understanding, getting into those different markets, specifically the markets that we are interested in supplying is in the United Kingdom, United States. We are even except for except for 0 to 1 was the first project that we've launched beginning of last year, and we're definitely looking into more opportunities in South Africa, just purely from the fact that there's change that's on the horizon, and that will definitely hopefully give us proper opportunities, and for you as an investor that wants to be in the local market, also that opportunity. The other country at this stage is going to be Australia, and that's where the Osprop Logistics 1 comes in. So that's the 4 countries that we're still going to focus on in 2018. Obviously, one of the things that we've really discussed in detail is that the environment is a continual changing environment. A lot is happening in America, as you know, with Trump now being in the saddle for about a year. He at least got one thing right, and that is the tax bill. Obviously, that is going to be really a booster to the economy of the US that has already been recovering. That has got a bit of an effect on the inflation. We will see inflation start creeping up, which is going to be sort of mitigated or being managed through the interest rate hikes, as we already seen during the course of 2017. Obviously, that actually means that we're going to see some compression on some of the interest that we will be able to, or cash on cash that we can actually generate from some of the properties in the US. But we, as a team, are looking into ways in how we can still provide a great return. Now, if you compare on the inflation, as soon as inflation increases, you want to make sure that you get real value for money. So from our perspective, that's what we drive. If we look at Australia and you compare the interest rates that you get in Australia, meaning the cash on cash on an investment, you'll find that it's a bit lower than in relation to the USA and South Africa. And the main reason that needs to be considered is that interest rate, the inflation and the real value of money, or real value of your money in your pocket. So that's why you shouldn't really compare it countries to countries. The more important thing is to consider the diversity in investing in these different countries, and that's one of the things that we really want to offer an investor, is that diversification in first world countries like the United Kingdom, Australia, and the USA. The sectors that we are going to focus on, and obviously, like I said, the times are changing, so we are continually looking into what is happening on the ground. If you consider Amazon recently, recently last week launched. No, sorry. Let me rephrase. Sorry, the time actually flew so quickly there, Neisner. I believe it was on Monday that they actually opened a store named Go. Now that store is the first store from Amazon after they bought a company called Whole Foods, which is a upmarket retail store. And that store is actually quite fascinating. They are using technology where you basically step into that store, scan your phone, and you start shopping, and the computer and cameras and all the technology around weighing what you're taking off a particular rack, and you walk out and it actually deducts all the necessary groceries from your account. So that's things that is impacting real estate, in the sense that you still have a store there, but technology is causing companies like Amazon that they are focusing more on warehousing than having a physical store, because you can buy online most of this stuff. So I'm quite curious to see how this Amazon Go is going to work going forward. But that's the type of things that we need to consider. And as I said earlier, it continually changes over time. So we need to adapt. And that's why medical is one of our safer bets, because of the growing population and aging population. And that's the thing that you will continually will be seeing from us, unless there's a dramatic change and or we cannot find supply because of a competitive market, specifically in the US, for instance. But we have gotten our people on the ground. Like I said, their main task is to assist us in finding the best partners to partner with, and making sure that you as an investor can find something that really can fit your risk profile, and at the same time ensuring that you get the best buck for your money. So in saying that, I just want to summarize the sectors that we're going to look into in the USA, UK, Australia, and South Africa. Some of them is going to vary. For instance, multifamily, we definitely going to look still at the US as well as the UK. Now, in the UK, obviously, it's not multifamily; it's what they call HMOs. It's a bit of a variant from that, and that's I'll go in more detail to what type of how would you say it? What really defines the HMOs or PRS, private rented sector. When we get to the LAL Group, which is our first UK deal or second UK deal, but first from the LAL Group. So, as I was saying, multifamily is definitely something that we will continue looking at, even though we found that there's definitely a competitive market. A lot of people are seeing the partners that we've got on the ground is really struggling to find real great value assets, and as you know, is that we are looking for that value add that we can actually bring to the investor. It's not necessarily an income stream, but more capital gain with some income to it. As I was saying, medical, we're definitely looking in the USA, Australia, and South Africa. Main reason why we're not doing that in the UK is because they've got the NHI, which is a national hospital insurance, which means that you going to have to buy the hospitals or the facilities from the government, which is not necessarily available at this stage. But myself is going over in a couple of weeks' time to go and see maybe there is opportunities in the medical industry. But what we do know is that in all these markets, USA, UK, Australia, and South Africa, we definitely want to be in the retirement or assisted living. There's a lot of opportunity there as most of the baby boomers are moving into that retirement stage, and they are definitely looking for more variety, and there's definitely a shortage currently. So, sorry, as I say, times will be changing, so there will be a short period of time that you will be actually to really profit from it, and that will be on a continuous basis being monitored by our due diligence team. Now, the other market, like I mentioned earlier, is the logistics and industrial. That's also where the OSPROP logistics come in. Is that that is definitely a growing market, and we're seeing specifically the warehousing, like stores of like Amazon. Those are the type of buildings when we're referring to the logistics and industrial self-storage. Those kind of properties that we really want to see if we cannot get some property partners that can provide us a good income generating assets from it. So our main focus this year is also going to be to really get more income generating deals on it. If the environment requires us to look into developments, which we call the growth product, we might consider it if the property partner is really established and can fit our stringent criteria set by the Independent Investment Committee. The last sector that I'm going to mention is the student accommodation. So they call it purpose built. There's still some room, hopefully in USA, UK, South Africa, and Australia to enter that market as well. As I mentioned, population growth is one of the factors that we really that mostly drive real estate investors. So that's why you'll always see us moving into areas where there is a population growth, has been for the past couple of years, and is forecasting that there is going to be enough industries around that particular town or province in that will stimulate that real estate growth, so that you don't get into a difficulty in exiting. As I'm always saying, is that one of the things that is important for us, and specifically me, the diligence and risk assessment manager, is that we want to make sure that we have an exit, because it's a great asset if you can receive an income on it, but if you cannot exit it, meaning gain a capital, get some capital gains on that investment over a period of 5 years or so, then from our perspective is we want to assist the investors that is making use of our opportunities to grow their wealth, because as you know, is that we want to empower 1 billion people by 2020. So we only got 2 years left, and so we are really working hard and going global. So yeah, So that's just for a long introduction into tonight's different opportunities that we're having, and just a sort of a heads up as to what's going to happen. So just to recap is that we are definitely looking into new sectors to provide a more variety on our platform. You would have noticed that in 2017 we really started to add more deals to the platform, and at the same time closing them quicker, just because of the fact that we have actually crossed 16,000 members on our platform now, which we are very excited about. If you consider one of the global CEOs of the UK, he mentioned just today that when they launched the UK, which I think, if my memory serves me correctly, was around November, there was only 8,000 members on the platform. So it is really exciting for us, and we hope really that you as a member or as an interested party really are as excited as we are in what 2018 is going to hold for you as a potential investor, and the opportunities that we are excited about offering for you. All right, now yeah, that's what I think is what I wanted to mention on the off the bat. What we're going to look now is into RH Medical 10. As you know, this is the RH stands for our property partner, and let me just quickly grab a sip. Richmond Honan. You, if you have followed us for a bit now, we recently closed Medical 9, I think 15th of December, which was a previous property from Richmond Honan, and this is the follow-up to that. Now, if I can just quickly give a surmise of who is Richmond Honan. As you can see from the slide, if you haven't been able to join us on the previous webinars, is that they got 40 years of experience in the real estate industry doing developments. They also stand surety for the deals. They are a niche market player. They've got a doctors network of over 2,000 doctors that they provide the service for. So effectively what their strategy is to go into different areas where there's population growth, where there's a need, and close to an hospital system, and providing that on the outskirts medical services to the hospital. Because of the fact that there's a continuous growth, some of the specialists is rather wanting to be off campus as to on campus, just purely from the nature of the hospitals growing to such an extent that they are basically moving some of those non-urgent cares into off-site or off-campus facilities. And that's what we love about the Richmond Honan Group, is the fact that they've got a great relationship and great prospects. So what we're always looking for is a solid property pipeline. So we don't want to just do one deal with a particular property partner. He's got to have more than 10 years of experience, and he needs to be a niche player. So we are confident that Richmond Honan is a niche player in the medical real estate market, and therefore we are quite excited about the future with them. Now, what is just to be clear, tonight I'm going to try and keep it within 1 hour. 20 minutes is almost up, and so it's going to be a very high level, quick impact through the investments, and hopefully just to give you a bit of background around it, why we're doing it, and what the quick numbers are. As I was mentioning from the introduction, is that please get in contact with our consultants if you want more details. We've got brochures, login, and they will provide the necessary information for you. All right, so this deal is quite similar to Medical 9 in the sense that we have prefixed the return. So it's going to be for a 3-year period with an option of 1 + 1 years. So what we mean by that is that, excuse me, If the market conditions are not suitable, then the partner just requested that we can actually extend it. So the average return for the investor is going to be 8%. The reason for that, the property partner is paying a 9% fixed return to us. But after the structure costs, you'll find that the return just drops that to about 8%. This building, as you can see, is the deal value is what we call 61.7 million. It's a 117,000 square feet building, which is quite a big building. It's a 5-story building, and it's actually an old Siemens building. So the idea with the property is that if you compare what the deal value is into relation to some of our other projects, you'll find that the dollar per square foot is a bit high. Now, the reason why that is higher is because there's about another 10 acres of land around the building that is going to be that's already been approved for a assisted living. So this is going to be there's going to be about 5 or 6 medical office blocks around this property. They're going to take the former Siemens building and convert it into a medical office block, and that will basically facilitate a wellness and retail center around it. So this is a long-term view, and for that reason, they only gave us 3 years, so that as they are progressing on the development side, that we as Wealth Migrate and our investors get the opportunity to know the property, the area, and then when they bring the new opportunities that they basically, yeah, it's understandable. Yeah, so let me just check if there's something specific I can highlight. So as I said, there's a 10.42 acres around the property that's going to be subdivided into different medical office blocks. The average lease terms that they've signed on this building, so just from a risk perspective, the property is already 100% leased. They have taken ownership of the property already. If I remember correctly, it was around September. No, sorry, let me just get my facts right. We had the event in October. Yeah, so they took ownership 1st of September. That's correct, yes. So by the time we had our US launch, we had it in this building. So if you go to our Facebook Wealth Migrate Facebook profile, you'll note that there's a video taken from the launch, and so you can physically see the building. They've actually done a tremendous job in the conversion, converting it into medical offices, where the planned of redevelopment was around 6 months, and they've actually pulled it forward to about 3 months. So that's the type of developer that they are. They really stretch the limits in outperforming their own targets. Now, the area is quite close to the Northside Hospital. It is a well-established area. There's about, I think, almost 100,000 cars that actually on the intersection close to where the building is located is passing by. So it's one of the arteries of the Atlanta area, specifically the Alpharetta area, and that's what makes this property so well located and ideal to invest in. So this is just a couple of pictures. As I said, the exit strategy here is to hold the investment for 3 years. After 3 years, if the market conditions are favorable, we'll exit with a 20% capital growth after the necessary 80-20 split between Wealth Migrate. As always, we only take our fees, performance fees at the back of an investment. So there's basically an 80-20 split. After the cost deductions, you're looking at a 14.7% capital gain on your original capital. it's not that high if you compare to some of the value-added products that we offer, but we also want to give you a definitely a risk perspective, deck it down by taking part of it. What are the average lease periods with these new tenants? Winston, yes, that is a good question. So the average leases are actually ranging between 10 to 20 years. Now the average, because of the size of the building, leans more to 18 years. So this is definitely not as common if you, from South Africa perspective, and even across the rest of the globe, you'll find that you are very lucky and fortunate if you can get a 5-year lease with an option to extend for another 5 years. And that's what's great about Richmond Honan, is that the way they structure these leases is that they actually allow the doctors to participate in providing them with the the TI, so the tenant installation cost. So usually when you participate in some of these buildings, the tenant has got an installation cost that sometimes goes to his pocket, or he have got a bit more of an escalated rental rate to cover the cost. And because most of these properties and specialist properties, the tenants are specialized, they are quite keen on signing a longer term lease to ensure the future. All right, Winston, major tenants that occupy a larger portion of the space or smaller space tenants? No, that is quite a fair mix, I have to say. It's let me just quickly check my numbers here. Yeah, so the average size, let me restate that. It's between 3,000 and 10,000 square footage. So it's how would you say? I think it's not that small. It's sort of medium sized, spread between 1, 2, 3, 4, 5, 6. Look, about 20 tenants. I should have put in numbers here. Yeah, it's about 20 tenants in the building, but medium sized of around 4,000 square footage is about the average, with 2 tenants being bigger than 10,000 square foot. All right, carrying on. So just quickly, what are the risks in this? Well, obviously there's your honoring the lease obligation risk. This is being decked off because in the property itself, they got reputable medical tenants. They make sure that the financial positions of these tenants are good, and it's long-term leases in place. And the debt cover ratio is also allowing for a decrease of revenue. So there's a lot of good mitigating factors that on the property side is being implemented to ensure that even though your investment is being the returns are being placed in escrow, so it's like a trust account where there will be drawdowns over the 3-year period. So the risk is being taken out that in this investment, the investor is not reliant on the property in itself, but the cash has already been placed outside. So why is it important that we still consider these tenant risks? Is that your tenant or your value of your building is being calculated on your what they call a net operating income. So if your tenants aren't performing and you don't have the proper tenants in place, your net operating income is lower, which means your value of your property is lower. And that's going to be important to make sure that in 3 years' time that the value has increased by this new tenants and refurbishment of the building. And for that reason, you will be able to get your capital with the capital gains back in 3 years' time. Right, carry on. So here we come to what we classify as our first income generating product from Australia. It is called Osprop. Bruce, I'm going to quickly answer that question before I get into the next one. Yes, Bruce, there is a ground lease in place in this particular deal as well. All right, Osprop Logistics. That is a new partner that we've approved at the end of last year. They are very a very reputable company in Australia. They have been they've got a accumulated experience of over 50 years in the property industry. We also believe that they are a niche player, and they are going to be one of our property partners that is listed on the Australian exchange, or let me rephrase, they've got a what they call an ASIC license, which means that they have to ensure that all the investment opportunities that they make available complies to the Australian exchange regulations. So that for us is excellent, because that means that the investors, how do you call it, risk is definitely less. I see I've made a typo there on the market segment focus. They are actually focusing not just on medical real estate. They've actually, the track record currently is more diversified. They like office buildings, retail or shopping centers. That's what they've done in the past. So what they would do is they would invest in these properties, refurb them, and then sell them out. Out of their trust. So they've got what they call a management, what is it called, investment trust, which actually has got sub-trusts. So it's a bit of a different structure. I'm not going to go into the detail of it than what we usually will find, just purely from a protective scenario and of the competitive nature that you find in Australia. They needed to make use of this particular vehicle rather than what your normal, what they call special purpose vehicles that we usually buy the properties in. In Australia, they've set up this management investment trusts to ensure that they can actually comply to their ASICs regulations, and that is one of the reasons why they do it. All right, so what we're looking at is what we define as a cold storage facility. Now, it is definitely something different than the medical that we've been presenting in the past. You will note that the internal rate of return is definitely a bit lower after tax. Just the tax rate is a bit higher in Australia. Obviously, we do advise that an investor must get some external tax advice. We are not tax experts. We are just taking assumptions that is valid at the time when we are packaging these transactions or opportunities, just to give you as an investor an indicative percentage. As you can see, as the project's return is a bit lower. The reason for that is not that it's a bad return. It's actually a great return if you consider it being in Australia. The reality of it is that there's no value add to this project, and that's what we were hoping to achieve with this particular deal. Is that one of our criteria with a partner is that we want to have a what you call it, a portfolio strategy, which means that we're not just going to do one building of the cold storage. They've already actually got another building, which is also cold storage, which effectively will allow you to group them together to move into a larger portfolio size, which is more attractive to your REITs and different investment strategists that is looking for, or let me rephrase, has got enough money and they want to buy rather a bigger block of assets than just one particular building. So they got this property for a great price, and that's the reason why they bought into it. Unfortunately, it's a single tenant, and that's from our perspective, one of the risks to this deal is it's a single tenanted building. We normally like to have multi-tenanted multi-tenanted buildings to invest in, purely from the reason is that that you're not just reliant on one tenant. What makes this investment the risk mitigated is that the main shareholder of Scott's Refrigerating, which is a national Australian national big transport company of cold storage, cold storage, cold products. They are owned by a listed company, and this listed company actually have given a guarantee for that particular for the lease. And what's also the other mitigating factor is the fact that this building is specialized. So what you'll find is that there's not a lot of different type of buildings in the area that actually will encourage the tenant to move to a different building, because it's so specialized. It's not just readily available. So from that perspective, we are quite confident that assists with decking off the risk, which is different than with the medical that we just looked at, is the fact that this lease term is unfortunately 10 years, but has got a 2 by 5 year option to extend. Now, there's the main reason also why the particular internal rate of return is not that high is because it's an inflation rated, inflation linked lease. So the payment only increased by about 3%, which is the inflation linked escalation that is allowable in Australia, or to be competitive in Australia, to make sure that you've got the proper tenant to it. It means that your value is not growing that much, unfortunately, because what we've seen now with the previous property that I showed is that they are changing the format, the demographic, or the sector of the building, which allows for a value add, which means that they can ask a different rate. And unfortunately, in this scenario, it doesn't have that opportunity. But like we said, what we like about this asset is it's an income asset, is a well-established business. The return is decked off. It's probably not the prettiest building, I'm going to confess, but it is well located. It's in the what they call the Yatala Enterprise Area, which is a largest zone industrial land area in Queensland. It's got over 4,000 manufacturing jobs. It's direct access to the M1 highway serving Brisbane, the Gold Coast, and it basically assists the Scott Freight ways to actually deliver easily to their destinations from there. Let me check if there's anything else that I can say about this particular property. Like I said, Scott's Refrigerator is a national operator with logistics facilities located in the major capital cities of Australia, and their parent company is AHG. So if you want more details, please get in contact with the consultants, register, and we can supply you with the necessary documentation that will go deeper into the details. I'm just checking out if I'm missing something that I really wanted to communicate. I think that is that. Like I said, the risks to this building is the fact that it's a single tenant, but it's a reputable tenant, and there's actually a guarantee in place. What is also interesting about this particular asset is the fact that our partners actually only leveraged about 50%. Let me just check that number that I'm not misrepresenting. Where is that number now from my notes? Just give me 1 second. Okay, that doesn't help. I don't see it quickly, but if I remember correctly, it was around roughly 45% leverage. And the reason for it is that they want to make sure that the debt cover ratio is really above 2%, and minimum investment amount is going to be 1,000 Australian dollars. So that makes it attractive to test your first opportunity in Australia. The investment holding period is actually 5 to 7 years. The reason why we said 5 to 7 years is the fact that they want to make sure that the market is favorable before exiting, and for that reason, this could be a bit longer period. This is what we call a level 2 deal, which means that we as Wealth Migrate is not participating in directly into the management of the property and the decision making as to when to exit. So the partner only indicated that they will be looking, if the market conditions are favorable in 5 years, to exit the property. As I mentioned, the reason why we wanted to do this is because we want to be in the logistical market, and this partner actually has got additional assets that's also called storage, and they will definitely look for additional properties to invest in that particular market to get us to the critical mass. Right, so that in a nutshell is what we call OSPROP Logistics 1. I'm looking forward to, during the course of the year, hopefully share another opportunity from the guys down under. All right, so this brings us to which is currently showing as a coming soon project, is called Lal Group Living Works 1. Now, it's a typical property in the UK, as you can see. It is located in a town called Maidstone in the area called Kent. That is southeast of London. What is great about this property, and that's one of the reasons why we definitely considered it, is that it is not in London. As you definitely will know, is that, excuse me, Brexit is on everyone's lips, and there's definitely going to be an impact on it. But as my research has shown in the last couple of months leading up into this investment, is that if you really consider the amounts of jobs that's being lost due to Brexit, or potentially being lost by Brexit, some of the figures that came out was only 10,000 people possibly. But the government, in their budget speech at the end of the year, indicated that they're going to spend roughly, if I remember correctly, about 4 billion on these on new industries, the industries that is disrupting the markets, the technology industries, the artificial intelligence, all these new sectors that's being that's really starting to grow now. They want to be again a country that's leading those those industries, as they've done in the past. Like for instance, the financial industry, they were for a number of years seen as the financial capital, being London. And though there's going to be changes, it definitely appears that the GDP might be not growing as fast as they would have hoped, because of the Brexit, just of the uncertainty. But all the research actually indicated that there's a lot of money from foreign investment actually flowing into the country, and particularly the southeast market. So that's one of the reasons why we are looking for current properties and refurbishments. So let me get into more detail of the particular building. This building is, as you can see, it's not as pretty the prettiest building at this stage, because this is actually an office block. This property is going to be refurbished. So we class this as a growth product, purely from the perspective that you are not going to, how do you say, get an income stream. This building is currently empty. So the plan is to actually change it into 39 luxury student apartments, not student apartment, apologies, studio apartments. And I'll get in more detail to that just now. But the idea is that it will be refurbished over a period of 18 months. During the 18-month period, the property will be actually already put into the market, and once they've actually find a buyer, because of the fact that there's 39 units, it's going to be all rented out, much like the multifamily that got to learn from in the US. So this is now just what we call an apartment block, and it's in the heart of Maidstone. It is 56 minutes by train to London. And what we've been seeing is in the private rented sector, there's a real attractiveness, because a lot of the millennials and the how do you call it, young adult workers, they're not necessarily hung up on having a big um, unit to live in. They just want to make sure that they in an area where they can live out. They can go out to a pub and get on the train, go to London, and see places, but at the same time have all the amenities that a normal property owner might have. In London, those that may know or may not know, that's the HMO is where like myself, when I was in London, you share a house with other people. So you've got a shared amenity, but you only have a room. You pay for it by week, and you have to share it with people that you either met in London, or maybe a couple of friends, and you decide to move into what they call a HMO house. Now, what these guys do, LOL Property Group, they the CEO is called Shahan Lal, and that's where the Lal Group comes from. He is a property entrepreneur. He was a finalist in 2017 at Property Property Entrepreneurs Award. He's got a master's degree in property, in European real estate investment. He's been quite actively in purchasing more what they call expertise. So they've actually bought in 2014 a quantity surveying company that's been in the industry for over 25 years. And in the 6 years that they've been actively involved in property redevelopment, they've already done developments, refurbishments of over 20 million in a portfolio. So it's probably not that big. What the reason why we like this group is that they've got a pipeline, they've got a plan. They also have got the property portfolio strategy that we're looking for. This particular transaction is going to be not being added to different properties. As I said earlier, I'm flying over to the UK in a couple of weeks' time to go and build out this relationship with them, and really get a better understanding as to how we can build a critical mass to in a couple of years' time actually provide a good income product and good capital gains from the UK. As most of your investors might know, the same with the Australian market. Your inflation has been quite low for a number of years now. It has been creeping up as well. So my expectation is that in the UK we'll also they actually at the end of last year actually did increase their what do you call it, prime lending. Though it's definitely going to be slower than in the US. But if I think once they've exited the Brexit, I'm quite confident that they might actually accelerate that interest rate a bit faster than usual. So that's why it's also important for us to make sure that when we look at these transactions, that if we leverage a property, that the interest rate is fixed over the period of the investment, just to make sure that we don't necessarily eat into the profits of the investment or the cash flow of the property. All right, so let me just check if I wanted to say anything more on the partner. Yeah, their main focus currently is the southeast of Kent, so they actually know that eastern part quite well. It's a really a growing side of the UK, and like I said, we are definitely moving into this UK market and are hoping to bring a number of new opportunities from the UK in different sectors that I've mentioned earlier. All right, so just going a bit more into the detail. So the deal value is 3.5 million. That means that includes the price of purchasing the property, which is around 1.8 million, and then at the same time the construction cost, which includes the interest that's already been capitalized into the building. Now, our equity available for the property is around 900,000. Like I said, it's 18 months, and we are expecting sort of what we call a midway 23.65% before tax, and expectation of after tax of 19.32, well, 19.31%. And like I said, unfortunately, there's not going to be an income being generated by the property. The idea is to build the property out or refurb it in 12 months time, and then another 4 months to make sure that the property is being fully leased out before selling it to a particular buyer. Now, you might ask, this property is still showing as coming soon. Now, because it's our first transaction in the UK, we've actually had a number of people already interested in the property, and we've almost got how do you call it? There's a lot of attention being given. Sorry, what's the word I'm looking for? Not interest given, but there's definitely still room available to invest in this particular deal. We are currently finalizing the exchange dates and what they call a closing date. So for that reason, it is not live yet. And because of the interest, we are not really sure if we're going to actually make it live. But like I said, there is actually equity available. So if you are interested, please get in touch with a investment consultant and really delve into the detail. So what is this brand, Living Works? Now, this is a new type, and that's why we said we like niche players. These guys have got what they call a brand, Living Works, meaning that it's much like an integration of your working environment with where you live, and that's why they are looking for these assets that's basically close into the center of the town, close to amenities, close to where you can work, close to the train station, and you get a country feel there. We see a lot of people moving a bit out of London just because of the prices, but also for the lifestyle. Just quickly, Winston, 23.65 projected IRR after how long? That is for after the 18 months. This is just a couple of pictures. So as you can see, it's a definite new look, modern feel to it, and in the UK in particular, they actually furnish the properties, and you rent it with being finished there. So that's why these actually is going to be how the property will be presented, which means that you as a young adult can just move into that space, just bring your bags, and there you go. So your market is not necessarily what do you call it, for young adults. It's also maybe for the guys that's looking to retire or moving down to a smaller space, but still wants to be close to walking distance of the necessary amenities. Just an interesting fact about the, let me just quickly get where I wanted to share. So the UK private rented sector, in 1991, there was only 2 million private rented households. By 2014, there was already 5.3 million rented house homes. So all the stats also indicate, that much like we said about the millennials for the multifamily in the USA, much more people are moving to a rental area, specifically if it's well located, like this property, rather than purchasing it, mainly because of the fact that there's the purchase price is so high. If you're a first-time buyer, there is now schemes, and the UK really wants to drive this market where Theresa May indicated that they're going to provide 300,000 houses. If you consider end of last year, they only built 164,000. So that's why this market is so attractive, and why you wanted to be part of this sector because it's growing. There's definitely a lot of people still in the market, and as I said, there are the UK is definitely still going to attract educated people to specialized sectors still to come to the UK. So I don't foresee currently that the UK can provide sufficient housing for all those guys moving into that environment, which is definitely the opportunity here. All right. The QS firm, Len, let me just go back. I think it was actually on the slide. Portis Chartered Surveyors is the name of the company. Do they have an office in South Africa? They are not that big, unfortunately, Len. They are quite well. They are specialist QS in the UK, so they're not an international brand yet. But as I've got to know, the partner is definitely looking to expand, and if he gets the opportunity to go global, I'm pretty sure he will. All right, so I think, Bruce, one of the questions is what's the minimum investment? Yeah, because this transaction is basically being filled offline. The minimum investment is definitely going to be not as low as £1,000. It's going to be £10,000, unfortunately, at this stage. But as I said, we are busy working on making sure that we can provide more deals, and hopefully that will be coming at a lower minimum investment rate. So what is the risks? It is unfortunately development. There can be development cost overruns, but the bank will allow an extended facility, and the contractor is on a fixed development cost. So there might be risks, but we have also mitigated by stating in the contracts that the law group being the facilitator and project manager, if there's any cost overruns, then they have to first dock up before we come to the investors if it's over a particular amount. But we are currently finalizing those details, and as I said, that's one of the reasons why it's not on the platform yet. And yeah, so we're finalizing those contracts, but the idea is that we can definitely deck off the risks at this stage. Right. Also, the other thing is that the interest has already been accounted for, because being a development loan, you're only paying interest on what you've drawn down. So from that perspective, the period of time with the raising of the rates, I don't also foresee that there's going to be a substantial increase in the interest rates over the next 12 months. That really will dramatically influence the returns. Right. I think that's quickly that. Let's carry on. All right. So as I said, the exit strategy is after 18 months. The property partners already, because of the history, they already will be marketing the property once they start building, to make sure that they've got not just it tenanted up, but also actually a buyer by the time the 18 months come in. Right, then the next project, and I'm just going to quickly run through it. I see we're almost at 8 o'clock, is Medical 11. This is Austin Street Capital. It's the team that brought us Medical 8. So I'm just going to run quickly through them. They also over 25 years experience in the medical real estate. As you can see, is also in Austin, and that actually accommodates what we've already earlier mentioned, is that it's a portfolio strategy. So now if we do get this transaction going, so it's coming soon at the moment, we are busy finalizing the necessary documentation, and it will go live hopefully in the next month or so. Then we can actually build that portfolio in Austin that will give us a good exit strategy at the end of the 5-year term. As you can see, the internal rate is around 14.84%. The minimum investment for this deal will be $1,000. Equity currently projected around 4.9 million. The average is of 8% over the investment period. So the first year is actually a bit lower, and then it sort of start increasing over the period of the investment to give you a nice 8% after hurdle rates are being paid. All right, so that's quickly. As you can see, if you compare it to medical aid, it looks quite similar. It's it's in a well-established area in Austin called Riverside Place, and it's a beautiful part of Austin. Austin is definitely one of my favorite cities in the US to visit, and they've, as you can see, got imaging machinery in there, and they've got, I think, the building. There's this. Let me just try to think now. We are finalizing the numbers. What was um, the vacancy? There's a bit of a vacancy, which allows for a definitely value add here. So what we're always looking for, as I mentioned earlier, is a value add scenario. The building is quite new as well. It was built in 2014. So there's not really a value add perspective from changing the building, but rather than getting a new tenant in or additional tenant in, which will then increase the value because of the net operating income increasing. Right, as you can see, what is important is that the interest rate will be fixed because, as I said earlier, we're definitely seeing the Fed raising interest rates. Now, this is where there's a difference between Medical 11 and 10, is the fact that we as Wealth Migrate is part of the investment. So we are also deciding as to when to sell, and we're also then making sure that there's an opportunity for capital growth. Like I said, this is not a fixed return. It'll definitely hopefully increase over time. Percentage vacancy currently, potential upside. Yeah, that's what I said, Winston, earlier. It's around 95%. Unfortunately, I don't have that number close to me. Yeah. Unfortunately, we'll once it launches, we will definitely get that numbers firmed up. But the last that I could remember, it was not more than 95%. Okay, as I said, similar year, the strategy is to exit in 5 years' time. Then the investment committee is reviewing the market conditions and will consider the best exit opportunities for the investors. If the market conditions is not appropriate, or if there's a favorable offer being solicited, unsolicited offer presented within 5 years' time, and it makes sense to exit, we'll definitely consider it. All right, that brings us to what is the last transaction. This is currently not yet on the platform. Main reason is that this is what we, if you were an investor in Medical 1, 2, and 3, and 5, by now you would have heard, and last week we had a webinar about it, is that this is what we've meant, and now the proof is in the pudding, they say. So we have actually accumulated about 15 buildings in the Atlanta area, and these buildings now is being bought by Richmond Honan. I'm not going to go into the detail of Richmond Honan. Here are just a couple of pictures of the buildings. So as you can see, there's a couple of smaller buildings, there's a couple of bigger buildings, there's a bigger size building which is called the Glenridge on the right side. What's happening here is what because of the relationship of Richmond Honan, they were willing to buy the Medical 1, 2, 3, and 5 properties and consolidate them into a new investment, which we call Richmond Honan Atlanta Portfolio, as well as adding another building to it, the one on the right, which is called Glenridge. That's about 150,000 square feet, if I remember correctly, which is going to bring us to a over 300,000 square footage, or 400,000, sorry, square footage of properties, as you can see on the map, that is well diversified across the whole of Atlanta. And the investors that invested in Medical One, they've already been invested since 2014. So we got permission and a mandate from them end of last year to look into maybe possibly selling this properties. Because of the fact that we've got a number of additional properties, we thought it made sense, given that the capitalization rates are currently moving a bit upwards. It felt like a great time, if we get the right price, to exit these 15 properties and provide our investors with a good capital gain, and at the same time the opportunity now to roll that capital gains into a new investment that is bigger than the one before, that gives you that critical mass. As you can see now, the deal value is 110 million. It's quite more substantial than what we've previously had and previously shown with, for instance, Medical 11. That was around 12 million. And most of the other buildings, like Medical 7 that we've had, Medical 8 was also in the region of 12 million. Now, this is a more substantial size of properties. The reason why we're doing this is that you get now a bigger value of the properties, which will allow you to be able to sell to a potential real estate investment trust, a REIT, what they call it. They are looking for specific returns over a particular time, so they don't necessarily care about a value add. They just want to know that they're going to get a good return. As you can see, is going to be an average of 9.2%, and they just want a stable income, decked off risk, given that it's 15 properties, or say it's going to be 17 with the additional Glenridge property added to the portfolio. This really decks off the risk for them, and this investment definitely makes it more attractive for these guys. So with the RH, the Richmond Honan Group coming in, their idea, and this is where the value lies, and that's why the internal rate is so high, is the fact that the Glenridge property that they add to this portfolio, they are actually going to change that building. There's additional property available, vacant piece of land next to it, that they're also going to create a new medical office block, much similar to Medical 10. But this time around, our investors get the actual opportunity to benefit from all these planned changes and planned new investment vehicles, and yeah, it's quite a mouthful. What is happening is that we've given our investors that's currently invested in Medical 1 to 5 the opportunity to take their capital gains and roll it into this investment, which actually then benefits them more. There is some of these investors that indicated that they actually want to exit this transaction, take the capital gains, and then either invested somewhere else, or their scenarios has changed. But the reality of it is that we are definitely going to have some equity available to be taken up in this portfolio, RH Atlanta portfolio. So that's why we are presenting it tonight, to give you as a potential investor the opportunity to look at it. So the exit strategy here is also 5 years. The idea is that in 5 years' time, Richmond Honan has indicated that they actually are planning on doing building a private REIT fund, and that will actually, give the investors a new opportunity to exit at that particular time, which means that there's a clear path of exit. Like I said earlier, is that for us it's very important to know that we can exit a deal. Francis, that's a good question. We have not clarified the minimum investment amount yet. Please indicate to an investment consultant that you are interested, and they can make sure that they provide you with the necessary details. Unfortunately, we've not discussed the minimum investment for this particular investment yet, but yeah, I think yeah, that is it. It was quite a long-winded one. I see it's now 8:10. I'm not going to take a lot of questions. I think I quickly answered them as we progressed. And yeah, I want to encourage you guys that if you can reach out to your investment consultants. If you're not a registered member yet, please sign up to the secure platform and indicate what you would like. And yeah, reach out. We can. We've got willing and what do you call it? Educated guys out there that is looking forward to speaking to you and assisting you in finding the right investment for your risk profile. I'm wishing you a great 2018. Look out for new webinars and events, and hope to see you soon. Goodbye.